fourth meeting of the Monetary Policy Committee since its inception in September 2016. The flexible inflation targeting framework will soon complete 8 years of its functioning. The framework has worked well in maintaining macroeconomic stability even during times of extreme stress. Its embedded flexibility has withstood the pandemic-related stress, the spillovers from the war in Ukraine, and the continuing geopolitical crisis that we face today. Today, while India's growth remains strong, inflation is broadly on a declining trajectory. Strong macroeconomic fundamentals of India have also led to greater confidence in our economic prospects. Let me now turn to the decisions and deliberations of the Monetary Policy Committee meeting, which met on 6th, 7th, and 8th of August. And it goes as follows. The Monetary Policy Committee met on 6th, 7th, and 8th August. After a detailed assessment of the evolving macroeconomic and financial conditions and the overall outlook, it decided by a majority of 4:2 members to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25% and the marginal standing facility rate and the bank rate at 6.75%. The MPC also decided by a majority of 4 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. So as you can see, there is good amount of convergence between market expectations and the RBI's policies. In other words, both market expectations and RBI policies, so far as monetary policy is concerned, are well aligned. I shall now briefly set out the rationale for these decisions. Headline inflation, after remaining steady at 4.8% during April and May this year, increased to 5.1% in June, primarily driven by the food component, which remains stubborn. While the fuel group remained in deflation. The expected moderation in headline inflation during the second quarter of 24-25, that is in the second quarter of the current financial year, on account of favorable base effects, is likely to reverse in the third quarter. This is something which I had also explained in the last monetary policy meeting in June, that in the third quarter we have a substantial advantage of the base effect, which may pull down the overall inflation numbers. But going forward, that base effect will wear out. Domestic growth, however, in these circumstances is holding up well on the back of steady urban consumption and improving rural consumption, coupled with strong investment demand. Amidst this confluence of factors, the MPC judged that it is important for monetary policy to stay the course while maintaining close vigil on the inflation trajectory and the risks thereof. Resilient and steady growth in GDP enables monetary policy to focus unambiguously on inflation. It must continue to be disinflationary and resolute in its commitment to aligning inflation to the target of 4% on a durable basis. Accordingly, the Monetary Policy Committee decided to keep the policy repo rate unchanged at 6.5% in this meeting. The commitment of monetary policy to ensure price stability would strengthen the foundations for a period of sustained growth. Now, this point needs to be appreciated, that ensuring price stability eventually results and supports a period of sustained growth. Without price stability, high growth cannot be sustained. So therefore, especially in a situation where our GDP growth is holding up well, we have decided to focus on inflation and ensure price stability, mainly to support growth. In these circumstances, the MPC reiterated the need to continue with the disinflationary stance of withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth.